Obviously, Asian central banks are going to be taking their lead from the Fed, although I think that the Fed trajectory on interest rates is obviously going to be easing at some point, but not immediately. But more importantly, I think that it's really not so much the Fed anymore. It's about the direction and magnitude of longer-term rates which are set by the market. And that's the thing that I think people are most interested in, regardless of whether or not the Fed cuts or does not cut by 25 basis points now or a couple of times later on in this year. So we do know that government balance sheets are extremely stretched, not just in the United States, but elsewhere. We do know that long-term financing rates have been elevated this year, and investors are rightly concerned about how that's all going to be funded going forward.
Is this coming to a head then, especially if we have tax and spending plans that are going to inflate the deficits and fiscal profligacy even further, and our bond market's going to have something to say about that in the not too distant future?
Well, you remember back in the day under Bill Clinton that James Colville famously said that when he dies he wants to get reincarnated as the bond market because then he can terrify everybody. So yes is the answer. The trouble is that obviously we know about all of this. We know about the level of indebtedness, etc., etc. The market at the moment has chosen to ignore it right up until the point in which it doesn't. And that will primarily be because at some point a bond auction is going to meet with very tepid or very low levels of demand, and that is going to start pointing towards investor unease. But Ray Dalio, for instance, was calling out the UK this week specifically on that issue, and we've seen the pound having been up, 12–13% against the US dollar by a couple of weeks ago, is now up 7 or 8. So it's starting to have a factor on different currencies. So, we'll see. But it's not looking particularly positive from that viewpoint.
Japan's economy seems to have hit a soft patch. We are getting an expected rebound in wages. Is that enough to restore consumer confidence, consumer rebound?
Well, it seems to be. Aside from the price of rice, which obviously is a real political touchstone in Japan, it looks as though consumers are getting a little bit more confident. The economy continues to be reasonably well supported, and that long-term thematic about restructuring of the corporate sector, cross-holdings and everything is very much, again, a bit like India, a sort of a decade-long story, which is supportive for markets and supportive for valuations.
Is there enough momentum driving corporate reform in Japan?
It seems so. It's certainly been gaining significant momentum over the course of the last couple of years, and it looks as though the penny has really dropped in terms of both companies and regulators, that these sorts of things, which have been quite restrictive from a market perspective, have to be dealt with for the benefit of not only the Japanese stock market, but obviously the broader Japanese economy.
So, tactically, do we need to get into a defensive crouch given the balance of risks, or should we perhaps not be too chicken little about the outlook on the macro economy?
At the moment, it's the latter. I mean, in beginning of April, a lot of people were saying, look, you've basically got to dump all risk assets because these things are going to be an absolute disaster. We did nothing. We sat with our positions, and thankfully that's worked out pretty well. At some point, there will be room for caution, but it's going to be more in relation to back to the traditional fundamentals. Earnings outlook, valuations, where do we think things are going to go? And at the moment, it's quite supportive, actually, specifically for the US, which is turning out that everything that we were all scared about at the moment, Trump's getting away with.